So let's look at another question in relation to the inventory and see how the standard plays out. I want you to stay carefully with me here because the structure of the question sometimes determines the way we work out. What is the value of Repeho's inventory at 31st December 20X7 according to IAS 2 inventories? Again, know the principle, lower of cost and net realizable value. That's basically what we need to do. Repeho. So what do we have? Let's read. The Repeho company manufactures a single type of concrete mixing machine, which it sells to building companies. Repeho is currently considering the value of its inventories at 31st December 20X7. The following data are relevant at this date. So this is the cost of inventory, 240. There are 85 mixing machines held in inventory. So in total, we have 85. Stay with me. The company has a contract to sell 15 concrete mixing machine at 225,000 each to a major local building company in January 20X8. Now remember, that is just the following day because our year ended is 31st December 20X7. So that is just the following day. The normal selling price is 260 per machine. Selling costs are minimal. Now, one thing you need to understand is that IAS2 states that when determining the value at which closing stock will be carried, the contract, any inventory that will be sold under contract, its carrying amount should be determined separately from the other inventories. So we're going to be doing that to here. So if we go back, there are 15 of the machines that has to be sold at 225. So really the net realizable value here for the contract is 225 because we are told that the cost to sell is minimal, is negligible. So if you compare that to the cost, you realize that the net realizable value is lower because the cost is 240,000, the lower of the two. So under the contract, we are going to be selling at 225,000 15 machines. So 225,000 by 15, and that is 3,375,000. Then we come to the remaining because the question said the normal selling price is 260,000. It's 260,000. So let's bring in the general inventories. And so if you look at that, normal selling price is 260. Cost is 240. Which one is lower? The cost. So in the general, we're going to have 240,000 multiplied by, there are 85 in total, but 15 is under the contract, so the remaining, and that is 16,800,000. So we add the two up and the amount, remember the requirement of the question, the value of inventory at the reporting date at 31st 12 20x7 will be plus 3375, and that is 20,175,000. So that is the answer to the question. So that is basically the idea about IAS2 inventories, how we determine the valuation using the lower of cost and net realizable value. I'll see you in the next video as we continue with our discussion.